When it comes to managing personal finances, the choices we make today can echo far into the future, especially when it comes to applying for a mortgage. One of the most debated topics in modern finance is the rise of buy now, pay later (BNPL) services and how they intersect with long-term credit obligations like home loans. BNPL has exploded in popularity, offering a convenient, seemingly harmless way to split the cost of everyday purchases into smaller installments. For many, it's an attractive alternative to traditional credit cards, promising interest-free payments and quick approval. But as millions embrace this new financial tool, questions are emerging about its unseen effects. Particularly on the sacred ground of mortgage applications, understanding the impact of BNPL on your mortgage chances requires a closer look at how lenders evaluate creditworthiness. Traditional credit reports have long been the backbone of mortgage approval, offering a snapshot of your financial behavior, including payment history, outstanding debts, and credit utilization. BNPL, however, often operates in a gray area. While some BNPL providers report your activity to credit bureaus, many do not, meaning you could be racking up significant financial obligations without them appearing on your credit file. On the surface, this may seem harmless, but lenders are increasingly sophisticated, considering hidden debt and spending patterns that hint at overextension. A history of missed BNPL payments, even if small, can signal financial stress, subtly undermining the confidence a bank places in your long-term repayment ability. The appeal of BNPL lies in its simplicity: a few clicks, a fraction of the cost up front, and the promise of immediate ownership. Yet, that simplicity can be deceptive. Financial behavior that seems minor, splitting a $500 purchase into 4 payments, can accumulate into hundreds or thousands of dollars across multiple BNPL accounts. When a mortgage underwriter examines your finances, the cumulative effect of these obligations, particularly if missed or late, can influence the perceived risk you present. Unlike revolving credit cards, which lenders clearly see and assess, BNPL requires deeper digging, sometimes pulling alternative data or looking at spending patterns, making it a potential blind spot for borrowers unaware of how these payments could shape their financial narrative. Mortgage approval is ultimately a delicate balance between your income, existing debt, and perceived reliability. While BNPL doesn't automatically disqualify applicants, it can subtly tilt that balance. Lenders want assurance that you can handle a substantial, long-term financial commitment, and any sign of overleveraging, even in small increments, can raise caution. The very nature of BNPL, allowing deferred payments without immediate impact on your credit, can mask true financial stress until it's too late. This creates a paradox: the more you rely on BNPL for convenience, the more you risk undermining the confidence lenders place in your financial discipline. The conversation around BNPL and mortgage applications is still evolving, with both financial institutions and consumers navigating uncharted territory. Some lenders have begun integrating BNPL data into their assessments, recognizing that traditional credit reports alone no longer capture the full picture of financial behavior. Borrowers, on the other hand, are realizing the importance of proactive financial awareness, tracking BNPL usage, ensuring timely payments, and understanding how even small obligations can influence large financial decisions. In the end, the story of BNPL is a modern cautionary tale, a reflection of how convenience in the short term can ripple into long-term consequences, and a reminder that in finance, nothing is truly free. Navigating the intersection of BNPL and mortgage applications requires a careful blend of discipline, foresight, and understanding. It's not simply a question of whether BNPL will hurt your chances, it's about recognizing that every financial choice, no matter how minor it seems, contributes to a broader picture of responsibility and trustworthiness. For those looking to secure a mortgage, the lesson is clear: awareness and prudence today can protect the dreams of tomorrow, ensuring that a tool meant to simplify life does not, inadvertently, complicate one of the most important financial milestones anyone can achieve.